Commissioner Kniezek,
Here.
Commissioner Clark-Holman,
Here.
Commissioner Dobb,
Here.
Chair Basham.
Here.
You have
Next
a
item.
quorum present.
Next
D,
item.
approval of the July 22nd, 2020 meeting minutes.
Colleen, I'll move. I support.
It's been moved by Commissioner Clean. Is there support?
Support.
Support by Commissioner Clark-Holman. Any discussion? All those in favor?
Aye.
Aye.
Aye. Ayes have it. Next item, Madam Clerk.
C, old business. There is none.
Correct. Next item.
Item D1, under new business, communication from Marcella Cora, Wayne County Legislative Auditor General, forwarding a letter from Plant & Moran, the county's independent external auditor, on the results of their audit of the county's fiscal year ending September 30th, 2019.
Okay, I'd like to welcome the Auditor General, Marcia Cora, and her staff and her guest, and welcome, and please proceed, Ms. Cora.
Good morning, Marcia Cora, Auditor General. What we have before us today, the one deliverable item we have is AU 260 letter. We used to refer it as a SAS 114. This is a required communication from the external auditors to the commission, the county executive, regarding the results of the audit. And then in order to, this will be the deliverable, but we're going to have a presentation from Plant Moran on the results of the external audit along with the single audit. So, but the one item we'll be receiving forwarding to the full board would be the AU 260 letter. So if Plant Moran would like to introduce the auditors, and then they can begin their presentation. And we're going to have the PowerPoint presentation on the screen.
All righty. Welcome.
Thank you, Marcy. I'd like to thank the entire audit committee for welcoming our team to present the results of the annual financial audit for the Charter County of Wayne for the year ended September 30th, 2019. With me this morning from Plant Moran is Amanda Ward. She's a partner that oversaw the single audit or the federal programs that we were touching on a little bit earlier. Joining her is Shawana Jackson, who again assisted in the single audit or federal programs audit for the past year. And then from a CAFR side, Keith Shemansky, senior manager, as well as Nikki Atchell. So as Marcy indicated, the presentation, and let me start my screen sharing here real quick, just to make sure everybody. Okay. I'm assuming that's looking okay?
Yes.
You see the whole, okay, perfect. So as in the past, what we thought we'd cover today were the deliverables at a high level. We'll talk about what was turned over to the county as a result of our audit. We'll go over the findings as part of the presentation. As in the past, we'll answer questions, you know, as the committee brings them up. I assume Commissioner Basham, they'll go through any questions. Will go through you, and you'll ask us to address them as we go along. Is that the protocol?
Yes, and to that point on your screen, your upper right-hand corner of your screen, it says more. If you want to raise your hand virtually, just tap that, and I'll see who's raising their hand.
Perfect.
Got you, Rick. Thank you.
Could I add something to Dave to that?
Absolutely.
And we had a discussion yesterday in our pre-audit meeting. We determined this will probably take 2 meetings. So based on what the chair indicated to us yesterday, we're looking at this to be the meeting where we go through the findings, you know, and ask any questions to Plant Moran regarding the actual findings. And then we're going to have the auditees come back at the next meeting to discuss the actual corrective action.
Correct.
Okay, thank you, Mercy. So as far as the audit itself is concerned, we actually started the audit, some of our preliminary work back in the summer of 2019 in June and July. We really, I'd say the crux of the audit happens in December, really through the December through the mid-March time frame. And I'll talk about the opinion dates. And though we'd love to be having this meeting in person, I think we all would, and probably in May as we have in the past, rest assured that the audit was complete in accordance with PA Public Act 2 and submitted to Treasury within 180 days of the county's year end. So the county did comply with that part of the Public Act to ensure that the completed audit was submitted as required. I'm going to move on to the next page. So as far as the deliverables are concerned, and I believe the Auditor General had pushed that out to the Audit Committee some time ago, but there's the Auditor's Report letter. So the county's CAFR statement is a compilation of the activity that was presented for audit, and that is put together by the county, and we offer an auditor's opinion based on the work, and I'll talk a little bit more about that later, the audit procedures that we perform to ensure that they're fairly stated. And what we can say is that we did complete our audit, and we were able to date our opinion on March 16th, 2020, well before the March 31st due date. And as a result of our audit procedures, we were able to issue an unmodified opinion, which is the highest level of assurance that we can give a set of financial statements. What that means is the statements that were presented fairly reflect the financial position of the county as of September 30th, 2019. And the changes in those financial position, which include the revenues and expenditures that were reported, as well as the statement of cash flows and the notes that were required to be included and disclosed within the document. So again, it is the highest level of assurance that we can give a set of financial statements, and we're happy to give as a result of the audit procedures we performed during the time period I indicated earlier. In addition to that, the next item is the letter to Wayne County Commission Audit Committee and the County Executive dated March 16th, 2020. That's the deliverable that Marcy alluded to earlier as far as the deliverable that was included in your packet. You may recall prior to the audit commencing, I would have sent out a similar communication where we would have talked about our audit approach, what we deemed to be the higher risk areas, how we were going to address those areas, and gave not only the audit committee, but really everyone on the commission the opportunity to contact me if they had any specific concerns with any area that wasn't necessarily being addressed. And we would take that into consideration, tailor our audit procedures, incorporate that as part of the audit. This letter really is, I'll say the final circle of that initial letter. So we talk a little bit about the results of our planning, the scope. We discuss on whether or not there was any significant standards implementations. What I would say is there was nothing in that letter that would raise some sort of flag that you should really be drawing further attention to. There will be some communications we'll be covering later this morning that we do need to bring to the commission's attention and this audit committee. And Nikki, Keith, Amanda, and Shawan are going to be discussing that in a little bit. In addition, I also indicated the single audit was performed, was dated March 16th as well. That's a federal program audit. So Amanda and Manju are going to talk a little bit, or I'm sorry, Amanda and Shawan are going to talk a little bit about how we determine what programs we would normally cover. But there was a separate deliverable on that. And as we go through the findings, I am going to move away from this PowerPoint and let you follow along as far as the items we really want to make sure that the audit committee focuses on a go-forward basis. So the single audit report would include a schedule of expenditures of federal awards. So that's really listing all of the awards that were received and expended during the year. There's notes similar to the CAFR. There's notes that are included, and then finally the schedule of findings and question costs, which would include anything that we felt need to be disclosed from not only a single audit purpose, but as a result of our CAFR audit as well. It's all located in one place within the single audit report document. So I know most of the time, or most of this meeting is focused on the CAFR and the single audit itself. But just as a reminder, we do issue 4 separate reports as well, the Wayne County Land Bank and the Greater Wayne County Economic Development Authority. So those are direct opinions. So what we really do is a separate audit of those 2 entities. They do get incorporated back into the CAFR, but they also have a separate statement as well. The Wayne County Land Bank, you may recall for the last 2 years, based on the level of evidence that we were able to receive, or perhaps what we weren't able to receive or verify, resulted in a disclaimer of opinion. What we're happy to report out this year is as a result of our audit procedures in the land bank for the year ended September 30th of 2019, we were able to issue an unmodified opinion, which again is the highest level of assurance that we can give a set of financial statements. So that's a real positive move for the land bank to move off of those disclaimers of opinions and ending up with that unmodified opinion. The GWCDC, again, an unmodified opinion, as I think the committee knows, this program, so to speak, is kind of winding down. It's got about $40,000 worth of assets left in it. And it is just, at this point, looking for a program that would qualify for its use. And we'd expect in the next couple of years that would probably go away as the resources are expended on the programs. As far as the building authority and the sewage disposal system, we also issue statements on those, and those are in relation to opinions. So essentially what we're doing is we're pulling this information out of the CAFR and issuing a separate report for these 2 systems. So again, these are fairly stated statements in relation to the information that was provided in the CAFR. So there's been, at the end, there's been 6 different deliverables, the CAFR, the single audit, and these 4 programs, and the required letter of communication that's included in this packet that was presented today. Just a reminder of what our responsibilities, let me move the slide here, what our responsibilities are under the professional standards. So the audit of the CAFR is done, or our audit, in accordance with GAGAS, or generally accepted government auditing standards. We have to express an opinion on the fairness of those financial statements. So again, those in this year, those were all unmodified opinions. But if we keep, at any time we don't feel we're receiving the level of evidence that we may need, it could result in a qualification or a disclaimer or an adverse opinion. But again, as far as the county is concerned and what we've delivered, these are all unmodified opinions. We're required to obtain sufficient evidence to provide a reasonable basis for forming our opinion. So there's economic limits. There's a reasonable length of time and reasonable cost. So what that's really stating is, as we audit on a sample basis, we audit towards risk and areas where there's potential for material misstatement. Just as a reminder, we do not audit every transaction that the county enters into for the entire year because it wouldn't result in a reasonable length of time, nor would the cost to audit every transaction most likely wouldn't be where the county would hope it would be for a regular audit. So as a result of that, this is reasonable and not absolute assurance. So that's why I indicated in the opinion, we deem these to be unmodified in all material respects. So I alluded to earlier, we perform the audit according to the planned scope. So that's the communication I alluded to earlier. That was stated back in October of 2019. Our audit work included the 3 phases. So I'd indicated we had actually started last summer. So we start some of our planning and some of our preliminary testing. We can do some of our testing before the year end actually happens, some of the transaction work, and we do that. The risk assessment and our planning, both internal and with the Auditor General and M&B's departments, happened in September, October. And then right around Thanksgiving is when we really hit the ground running and perform a majority of our audit work, which runs through the mid-March period. So just to kind of add on to that, so I'll say COVID hit pretty much near the end of our audit. We were very, very close. I think for the most part, our field work was done. But our team and M&B's team, as well, the Auditor General's team, did work together remotely, I'll say in the last couple weeks, to ensure that the T's were crossed and the I's were dotted and everything was submitted to Treasury on a timely basis. And then the last item I just want to allude to real quick is the county did implement two standards as required, GASB statements number 88, which related really to the disclosure of debt. It didn't change any of the accounting that M&B was performing related to debt, principal, interest, any debt issuances. It just related to how it was reported within the notes of the statement. And then the other one is GASB 89, accounting for the interest costs incurred during the year. There are a few GASBs out there that really 100% of those in finance can agree are good, and it can actually save a bunch of time, and this is one of them. So it allows accounting departments, instead of during a construction period, any debt issuances that were had, and if you're paying interest before GASB 89, you'd have to capitalize that interest and add it to the cost of whatever asset was being constructed. Under GASB 89, you just get to continue that as an expense. So that really is helpful, and it's less for any finance department to work through as it relates to construction. So with that, I'm going to turn it over to Keith, who's going to take the next part of the graphs. Keith? Thank you,
Mr. Chair?
I'm sorry?
Commissioner Kleen.
Yeah. I have a question on that Gatsby statement 89.
Yes.
Could you translate for me? Because I think we got a big construction project going in the county right now. So what does this capitalizing of interest? Can you cut through the fiscal terms? What does this really do, and how does it affect us?
It affects you as a county and how you're paying things. Not at all. So let's just say that you've got a project that costs $1 million and you bonded for it, Commissioner Kleen. And historically, if that project took, let's say, 2 to 3 years to complete, any interest paid on the loan to construct this building, instead of it being expensed, when you pay it, instead of it being expensed, as it would be required to be capitalized and included as part of the asset. So eventually what happens is instead of it ending up on the income statement, it ends up on the balance sheet. So it's part of the cost of the building, which, and Matthew can attest to it, really means you're kind of tracking it one way for budget purposes, and then you've got to treat it another way for reporting purposes. What GASB 89 said is, you know what, we're going to get rid of this capitalization part of it. When interest is paid, you expense it, you keep it expense. You do not have to add it to the capitalized cost of constructing the asset, which in my case is pretty simple, but you can imagine projects that can take 3, 4, 5 years to complete, and the number could get quite large, and it's just really, I'd say, an added burden.
And what you were trailing off on the end there gets expensive. What?
Well, it is expense, but it was more of a burden to the finance folks, because they're more concerned, and I think most of us are concerned. Here's the cost of the debt. Let's expense it. What is the benefit for adding this expense to the cost, the capitalized cost of the project? Other than that, the cash goes out and the payment goes out no differently than it had been before the implementation of GASB 89.
Thank you very much. Thank you, Mr. Chair.
You're welcome. Next, please proceed.
These next few slides all summarize the letter that covers the required communications under the auditing standards. So there are a number of topics we're required to address and disclose any deviations from our plan or any exceptions from normal audit procedures. So in many of these cases, there were no such issues, and I'll go over those very briefly, and then I'll provide a little bit more color commentary on those items that were a bit outside the ordinary. So on the first slide, we simply state there were no transactions entered into by the county for which there was a lack of authoritative guidance, and there were no transactions that were posted to a different period than when the transaction actually occurred. So everything's in accordance with the GASB standards and recorded in the proper period. We're required to disclose all the significant estimates included in the financial statements, simply acknowledging the fact that not every amount recorded in the CAFR is based on cash in a bank account or an invoice received from a vendor. So the largest estimates are listed here. They're the estimated liabilities for workers' compensation, certain healthcare benefits, and legal claims, the pension and retiree healthcare liabilities, and the estimated refunds for chargebacks and property tax appeals. So in the case of the pension and OPEB liabilities, those are based on actuarial evaluations, which include significant estimates for the future return on investments in the trust, how long employees are going to work before becoming eligible for their benefits and collecting them, and then how long they'll live to collect those benefits. In evaluating those actuarial evaluations, we thought all the assumptions and the methods used by the actuaries were fair. The estimated liabilities for workers' compensation and other legal claims are based on the county's specific history with those types of claims, as well as the facts and circumstances that were in place both at the end of the fiscal year and a few months later as we were performing the audit. And the estimated refunds and property tax appeals are again based on history and trends. We thought all of these estimates were reasonable and properly stated in the financial statements, which allowed us to give our clean audit opinion. We'd be required to disclose any disagreements with management over accounting matters, but there were none during the year. There were also no difficulties encountered in performing the audit. And we would also have to disclose any corrected and uncorrected misstatements identified during the audit, of which there were quite a few actually. So these are discussed in more detail in the first finding when we get into the report on internal controls over financial reporting. So I'll hold off on going into detail on those for just a few minutes until we get to that slide. At the end of the audit, we ask management to sign a representation letter, essentially telling us that they've provided all the necessary facts and information and to the best of their knowledge properly recorded the activity during the year. And we received that letter as of our end of audit date. And then finally, if there were any communications with other accountants, essentially opinion shopping to see if other auditors would accept certain items that perhaps we weren't comfortable with, but there, to the best of our knowledge, no such consultations with other auditors.
Can I jump in for a quick second? I would like to also welcome to this meeting Huey Newsom, the CFO, and Matthew DeVry, the Deputy CFO of Wayne County, and just welcome to our meeting. Thank you. Please proceed.
Sure. At this point, I'm going to turn it over to Nikki to discuss the next few slides.
Hi. So the next few slides discuss the 3 different classifications that are used when we have findings related to our audit procedures. So a control deficiency is when the design or operation of a control isn't in place to prevent or detect misstatements on a timely basis. But typically there are mitigating controls or factors in place that would prevent a material misstatement from happening. Moving to the next slide, a significant deficiency in internal control is more severe than a control deficiency, but less severe than a material weakness. And it is important enough to bring to the attention of those charged with governance. And then on slide 16, a material weakness exists when internal control deficiencies lead to a reasonable possibility that a material misstatement will not be prevented or detected timely. And then Keith is going to get into start with the findings on the next slide. But of the 11 financial statement and single audit findings that we'll cover, 10 of them are categorized as material weaknesses, and 1 is considered a significant deficiency. Keith?
Keith, you're on mute right now.
Yep, sorry about that. So as we go through the findings on related to the financial statements, I will point out they are all material weaknesses, the highest level of financial statement findings that we have, and the first 7 of which are repeated findings from the previous year.
Ugh.
The first finding relates to the corrected and uncorrected misstatements that were identified during the audit, which I alluded to earlier. There were a fairly significant number of those, partially due to the fact that the county personnel didn't necessarily have all the time available or the personnel to fully investigate and monitor all of the activity throughout the year, and particularly the year-end closing entries. So as we were performing our audit procedures, if we identified misstatements, we brought those to the attention of management, and they concluded on whether or not they were significant or something they wanted to post and reflect in the financial statements, or if they were immaterial, they had the option to not post them. So some of the more significant areas in which we did identify misstatements that were made were to capital assets, certain revenue transactions, and issues involving cash, and particularly the reconciling items on a monthly basis. There were also a small number of insignificant items or past adjustments. In total, the value of the corrected and uncorrected misstatements were about $75 million, but all of the significant ones were posted and are reflected in the CAFR.
Keith, real quick, you can see the findings?
Yes.
Okay.
Mr. Chair,
Yeah, go ahead. Please proceed.
Mr. Chair,
Sure.
this is Commissioner Daub. I have a question. So is that the impact, the $75 million of the corrected, uncorrected misstatements that had not been recorded in the county's financial statements?
The $75 million is sort of an absolute value of all of the misstatements that were identified, including those that were corrected. The uncorrected ones add up to a much smaller amount. And really within even the ones that were posted, there could be misstatements that were going in different directions. But to give you sort of a scope of the total value of the adjustments that we identified, we summarized them that way.
Okay. Is it possible to provide a few examples of the more significant adjustments?
Sure. So I mentioned capital assets was one of the issues. So some of the issues that we identified there are actually specified out in one of the other findings, but to get into them right now, there were some issues with the jail transactions that began in 2018. So when that agreement was implemented in 2018, part of it was the removal of all of the existing jail assets, as those are now part of a sale-leaseback transaction. So the county did the best of their abilities to identify all of the assets related to those properties that were sold to the developer. But in 2019, they identified a fairly significant group of items that should have been disposed of in 2018, but instead were ran through the books in 2019. There's also a fairly complex adjustment related to the sale-leaseback transaction. And part of that entry was posted to an expense account rather than the proper balance sheet account, and we identified that during the audit. Okay. We also identified some projects that should have been placed in service. They were completed, but still recorded among construction in progress. When we started the audit, those were moved to the proper category and depreciation began. And in looking at the detail of the existing assets, we found some projects that were placed in service a few years ago for which depreciation had not yet begun to be recorded. And so when we pointed those out to management, they made those adjustments as well. And those were properly stated in the financial statements.
I guess I got a question. Is it because we have, this might be to Matthew or someone from the administration, is it because we have, I guess, less manpower, new people coming in? Why are we having these little disconnects?
Matthew DeBay, Deputy Chief Financial Officer. As it relates to the fixed assets, this has been a thorn in the side of management and budget for many years now. We have seemingly had almost continuous turnover in the folks that manage our accounting and reporting of fixed assets. And so that has caused us to, every time somebody comes back in, we have to retrain. And so things tend to get by new folks that experienced personnel would catch and be able to either correct directly or bring to management's attention for us to dig more into and figure out that there's a correction needed. On the completion of the fixed assets going into service, we had a communications problem last year with some of our project management folks over at DPS. They reported certain projects as not being completed as of September 30th, as we were starting the year-end close process. And then as the auditors were in looking at and getting verification that those projects were in fact not completed, DPS came back and noted that in fact those projects had been completed and completed prior to the end of the fiscal year. So our accounting was behind because we had not been notified of project completions timely. And so we worked, as those were identified, we worked with DPS to make sure that they were going to let us know more timely as projects completed. As far as the fixed asset issue related to the sale leaseback, we had an issue back in 2018. If you'll remember all the way back last year when we were doing the audit committee for the audit for the CAFR, there was, if memory serves, I believe it was $16 million, give or take a couple million there, if you'll excuse me. I believe it was about $16 million of fixed assets that were identified as needing to be removed from our books for the fiscal year 18 audit. Unfortunately, once we get past a certain point in the closeout process, we can't go back in time and take those off the books because our accounting system won't allow us to do that and for the accounting to be correct. So what occurred is we did a manual adjustment so that the 2018 books would be correct. And then in 2019, what we should have done is to force the system and then make the correction. When we tried to do that during the year, we weren't able to, and it took us quite some time to work with some outside folks to try and figure out how to get the accounting system to record these transactions properly. And so and Keith will correct me if I'm wrong, I think we finally figured it out. It was probably January or February when we were able to actually get the fixed assets for those disposals to correctly show as being disposed of. Part of this is lack of personnel. Part of this is turnover, which makes it tougher. And part of this is we're working with an antiquated system that was designed to have lots more hands in it. It's more of a manual process-driven system. And so things that 20 years of technology would fix, we're still living in the dark ages a little bit on some of these, where it just takes somebody sitting down and figuring out how to, I don't like to say it this way, but it kind of is true, is to fool the system into doing what it's supposed to do versus how it was originally designed way back in the day.
Well, you're invaluable to the county, and I'm not just saying that. And how can we as commissioners help the administration to be proactive versus reactive so that we don't have repeat findings next year? And again, when we do layoffs and stuff, do the administration take into account the folks that they're laying off or the folks that may be retiring? I mean, how can we, or is there anything that we can do to improve this process so that next year we don't have repeat findings from this year? If that makes sense.
It does, and unfortunately, with the
I'll write that down. Makes sense.
With the financial situation the county is in, we've never recovered from the Great Recession. Financially, we've never recovered. If you look just at property taxes as kind of a bellwether of the county's finances, we're last year, which is probably the best collection year we've had in the last 10. We were at about, memory serves, about 305 to 310 million of property taxes. Mm-hmm. Back in 2016, 2007 or 2008, I think we were about 370, 375.
Mhm.
And so we're dealing with 50 to $60 million less. And now we're going into another recession. So it's a continual pressure downward on the resources available to manage the county's finances. I did a quick look and said, okay, well, if we go back to 2000 and I look at management and budget staffing levels,
Mhm.
right? We're currently today at approximately 50% of the staff that we had 20 years ago. We're still running the same systems. We have the same accounting software. We have,
To
granted.
that point, can I jump in on that one?
Mhm.
Aren't we upgrading our systems?
We're in the process of upgrading our systems, which will help hopefully relieve some of these manual processes that we rely on. We rely on a lot of folks just knowing how to make the system do what it needs to do versus the system helping us get things done. I joke that, we have certain folks that know exactly how to kick the copier to get it to work because we're just using old technology. We just have to have folks that know that, yes, the normal way of entering this data is this way, except it doesn't work if you do that. You have to know that you have to go someplace else and do this other thing and then go into another screen and set off a process manually for it to do the calculation. Well, those are things that are not in the system documentation. They're not in the original instruction manuals that we have from implementation back in 1998, 1999. It's just somebody's been doing the job for 10, 15, 20 years, and they just know how to get things done. And unfortunately, to replace somebody with 20 years experience at a function takes 20 years. And so as we've had turnover, we run into these issues where, the person thinks that they're doing what they're supposed to be doing. It all looks okay day to day. And then we go through the audit process and somebody's taking a look at it from a different perspective. And they say, that looks funny. Let's dig into that a little bit more. And when we go through that, we find out, oh, there's a manual process that you have to go into JD Edwards and periodically run. And it's supposed to be in a queue of manual processes that we have an automation feature that we've bought separately to make those processes run automatically every day. And for some reason, that process is no longer being called and it's no longer running. And when did that stop? There's no bells, there's no flags being, there's nothing to indicate to us that something has gone wrong until we get to a point where somebody looks at it and says, that 12 million, shouldn't that be more like 30? And then we go to a process of looking at it through the audit process. In my mind, that's one of the most valuable things as an auditee that the auditors bring to us is day-to-day things may look fine to me just because I look at it every single day. When they're coming in from the outside, it looks funny to them because they only see it once a year. And so that's helpful for us to get that, that second opinion that says, this does look a little weird. We should look into that. And when they find things, it becomes a finding. Our fixed asset findings this year for fiscal year 19 are a little different than our fixed asset findings for fiscal year 18. And they were different than our fixed asset findings for fiscal year 17. So we've made progress as we find issues. We make progress, but the system is also, and the challenges of staffing are hindering our ability to get to a point where we can actually get this particular finding off the books as corrected and no longer an issue. The county has a lot of fixed assets, somewhere between $2.5 and $3 billion of fixed assets, approximately 6,500 individual assets that we track. And we've got like 1.5 FTEs assigned to keeping track of 6,500 items, somewhere between $2.5 and $3 billion worth of value, plus I think something like $100 million a year of year-to-year transactions for projects. And so it's a monumental challenge, and we try to do our best to stay on top of it. It's also one of the areas that is, I would say, less value add to the county. If we're $30 million off on fixed asset computations, it does not impact any of our employees as far as them getting their paychecks. It doesn't impact our vendors getting paid. It doesn't impact the projects being completed timely. It doesn't impact whether the road is built to spec or not. And so when it comes to dedication of time and effort, certain accounting functions have to be deprioritized and others have to be made a priority. Fixed assets is one of those that has less value to the ability of the county to maintain its operations and levels of service. And so we try to staff it as best we can with the resources we have, but it's also an area that's less valuable to the county overall than other areas. We're going to make sure that payroll is better staffed. We're going to make sure that AP is better staffed. We want to make sure that those areas of the county that generate revenues are better staffed. And so if we have to pull personnel in a different direction, fixed assets might be, it hasn't been so far, but this might be an area where we might have to say an FTE and a half is we can't afford it anymore. We may have to drop it to 1 FTE. And if we do that, then the likelihood of more findings and bigger findings comes along. But again, they're findings, I don't want to say they're paper findings, but they're findings of a financial nature that don't have a significant effects on our ability to provide service.
But looking at this from a macro point of view, the housing prices, you had mentioned it earlier, that the property values go up, so we have more revenue coming in last year.
Mm-hmm.
But there was a moratorium, and we also, the county, from a financial point of view, relied on foreclosures. And so there was they put a moratorium on foreclosures, so there'll be less revenue coming in from that next year.
Mm-hmm.
And so have you taken into account about the moratorium on foreclosures and those sorts of things that we rely on? Like, I think the treasurer was they sent over 30 plus million a year. Has that been looked at?
It's through the budget process. We absolutely include estimates of what we think and what the treasurer thinks is the long-term trend or patterns in the property taxes. We also include things like any shifting trends in the MTT, the Michigan Tax Tribunal. If we go back to the bad old days of the MTT in the 2000, I would say maybe 2008 through 2012, where the MTT was really hitting every government in Michigan pretty hard on reducing Audit taxes because of especially on the commercial industrial properties. And so, those are things that are included in the thought process. I have not looked at the 2021 budget. I've been focused on a couple of things here recently, but I'm sure that the 2021 property tax estimate for 2021 revenue for property taxes is lower than the 2020 original CEO recommended budget from last August or last July, for a year ago, last July. So, those things are taken into account. It's a guessing game, right? We're trying to think what the next 12 months are going to look like, or 14 months are going to look like. But that's just an overall downward pressure. If we extend the thought process back more than 20 years and we say, okay, we had the Great Recession in the middle, every time we have a recession and property values drop, they rise so slowly that we never get back to the old high before the next drop in value. So over a very long period of time, it's an ever decreasing source of revenue for the county. There's maybe some circumstances if the stars aligned and we had, a 5% rate of inflation, which is the cap for growth in property tax under Headley and Prop A. If we had 5% inflation and exactly a 5 or slightly above 5% rate of property value growth, we might be capturing things quickly enough to, get back to that high point before the next recession. That's maybe technically possible, but it's certainly, I don't think, very likely. I think the Michigan governments and Wayne County in particular are going to see this, if we try to extend out the thought process to 40 or 50 years under our current system of taxation for property taxes, it's going to be an ever decreasing amount, because when we can't get back to the old highs before the next downward trend starts. Well,
we appreciate your input. And anyway, it's been very helpful to me. So, but thank you. Keith, please proceed, Keith.
Mr. Chair?
Oh, Commissioner, I'm looking up there. I didn't see your hand raised virtually, but go ahead, Commissioner. That's all right.
Yeah, my hand's raised. I'm going to give up on the virtual hand raising here in a minute.
Okay.
But a couple of things here, Mr. Chair. In the discussion of the sale lease agreement, it wasn't said explicitly, but we sold our jail properties and Frank Murphy, the properties downtown, to Rock in anticipation of building the new jail. And then we have a lease agreement with them to lease those buildings back while we still have to occupy them. So that was an interesting discussion. Mr. Dubé, I've done simple assumptions that if we look at our property tax revenue in 2008, before the effect of the criminal behavior of banks in New York with regards to valuations of bad mortgages, if I just flatline our 2008 numbers, they don't go up or they don't go down over the next 10 years, I estimate that the county is out somewhere around $800 million from if you just flatline revenues over those 10 years. And of course, without that criminal behavior, property tax values would have continued to go up, presumably. So 800 million to maybe $1 billion is what we're out because of those criminal banks. Mr. Dubé, you mentioned your staffing is down 50% since I believe you said 2000. Can you give me actual numbers on that? How many people that really is?
Well, if you look at the number of budgeted positions back in 2000, and we take out the folks that have left because we moved, we took out the airport, and you take out the mental health. You adjust for the sale of the sewer systems. So there's some assumptions on my part there, but we would be somewhere around 180 positions. If we go back to 2008 and we didn't have, or 2000, we didn't have those functions, we would have within management and budget around 180 positions total. Right now we're in the upper 80, low 90 figure, depending on open positions. So we're somewhere between, I would say, 50-55% of the staff that we would have had 20 years ago. So, I think we do a pretty good job overall with the resources that we have. It's a big challenge. I don't like a finding probably as much as anybody else, maybe with the exception of Commissioner Basham. But I don't like findings. But at the same time, they're also, I think, partially a reflection of the interplay between constraint of resources, both monetary and people.
No, you've explained that. I don't want to cover that turf again, but I wanted a better understanding of the numbers. The commission's going to start looking at next year's budget here pretty soon. Is there additional positions for management and budget in this upcoming proposed budget? Or funding 10, 12, whatever the number is, more positions? Are we going to get more positions hired in management and budget with the proposed budget that's coming from the executive?
I have not had a chance to look at management and budget's budget. The budget team works with the individual divisions, but I don't believe we're going to have a significant staffing increase from where we are today. I'm hoping that we'll get closer to where we were in staffing to 2019, which, if you remember, we had a number of findings then. We weren't heavily staffed. I think we just had more staff than we do today. The difference between budgeted positions and open positions, in years past, we've normally run, we've had about 100 staff for every 120 positions. So we run about 16%, 17% vacancy, just because it's been hard to hire qualified governmental accountants. Governmental accountants are not traditionally trained at the college level. There's a few college programs that actually train young accountants directly in governmental accounting, but most accountants who come out of college with a bachelor's degree in accounting or a master's degree in accounting have had 1 or 2 credits in governmental accounting.
Yeah, you've raised this issue, and other people have raised this issue before, that the colleges are like governmental accounting. We don't know. You also talked about, very interested in your discussion, Mr. Dubé, about projections of future property tax revenue, and you mentioned a couple assumptions you have made. I would like to see, coming out of the Office of Management and Budget for Wayne County, some sort of report to the commission that more thoroughly discusses property tax revenue, because again, as we're doing budgeting and approving, you know, if we're really looking at a downward trajectory on property tax revenues going forward, I think we need to know that. I don't want to have that happen, or at least we need to have good numbers that look into the future, because I don't want to come back every year and go, oh, this year there's less, this year there's less. We have to plan for it if we know that that's coming. So I would be very much interested in a report on the projections for property tax revenues for the county going forward, because this also gets into the discussion in Washington, D.C., whether they want to help local governments or not in future CARES Act type legislation. So I'd be very interested in seeing that. I guess to the auditors, a few slides back, you mentioned that there were corrective action plans that have been done for all of these findings. Is that, did I see that correctly?
Yes, Commissioner Kling. So, and I think, sorry, I got a little technology issue and I'm back. And when I share the
It's the life of COVID and the life of Zoom, baby. That's how it goes.
But at the end of each finding, there is a recommendation that's listed, and there's a view of responsible officials and planned corrective action plan. So at the end of each finding, the last so-called paragraph is what the county's response and corrective action is at this point.
Yeah, that's a statement. It's not necessarily a corrective action plan that I'm looking there. Is there an actual plan that has been submitted, or are we looking at what has been submitted for how they want to fix it? Because what I'm getting at is, am I going to see any more throughout this year? Is this the only thing I'm going to see until the next audit?
Can I add to that?
Yeah, please.
In our office, we're going to do a follow-up on the corrective action that the auditees are taking, then report back to the committee. So we would see some action, or at least what their plan of action is, before we have to wait for the next audit.
Okay, yeah, because I didn't want to wait till the next audit to find out what the results were. So I was wondering what I'd be seeing, you know, throughout this year with regards to those.
At least some type of status on where they are with their corrective action.
Yeah. And Mr. Chair, if you would allow me, I have one question for the commission finance. I call him the commission CFO, but I know that's not the title. Mr. Abo.
Mark, are you there?
Yes, I am.
Mr. Abo, there was discussion from Mr. Dubé that on these findings, that although they are in the kind of critical category, that some of these findings have a lot more to do with the day-to-day functioning and the day-to-day statements of the county than others. Mr. Abo, can you comment on these findings, and can you comment, like, following up on Mr. Dubé's comments, like some are more important than others, that these are the ones that really need to be attacked and to attack now, especially since they're repeat findings, and which of the findings are, yeah, that's not good, but given all our problems in the discussion around staffing and all of that, that finding doesn't have the fiscal impact on the county and can wait a little while to get corrected. Are you able to rank these findings in terms of what is the most severe and what is to the least severe?
In my opinion, I think that Matthew characterized it well. He was making the difference between what affects operations and what does not affect operations. And you know, the value of our fixed assets is something that appears on our balance sheet, maybe evaluated by, you know, somebody who's looking at us to give us some sort of a rating, but it doesn't affect operations, and it's not a liquid asset. So it can't be used to, you know, pay a bill, so to speak. So I don't disagree with Matthew's characterizations, and I agree that when resources are limited, we do have to prioritize where we put those resources to use. But I would like to speak on the property tax issue as well.
Well, before you go there, Mr. Abbo, from my fiscal advisor for the commission, I'm interested in seeing from you some sort of a risk ranking of these findings, rather than just verbal here, where you can say, yeah, on this finding, this is the effect on the statements. It really doesn't affect operations, because we haven't talked about all 8 of them, and we're probably not going to today. But I would like to get a ranking from you and your own take on the severity of operations and what really needs to be done. Is that something you can do?
Yeah, we could do that.
I think that would be very helpful to us as decision makers, so that we know what are the real, from your opinion, you're our advisor, what are the real findings to really lock in on, because that might also play into staffing decisions in the budget too, how many people we need to have. So we'll talk more about that later, Mr. Abbo. I hope we can get something like that. I think it'd be helpful.
Of course.
Thank you, thanks, Mr. Klein. And Mr. Abbo had another comment to make.
Yeah, again, Matthew pointed out to the loss of revenue because of property taxes. Back before the Great Recession hit, our taxable values were more closely aligned to our state equalized values. Now, the problem in generating revenue and recovery is that the revenue for counties and local units of government is based on property taxes, and there are limitations in that growth. But we will not have the impact that we had in 2008 and 2009, because at this point in time, our state equalized values are $58 billion, and our taxable value in the county is $44 billion. So before we really take a property tax hit, we have to lose $14 billion worth of value, because the state equalized values have grown since the Great Recession, but we've been unable to translate that into increases in taxable value. Last year was probably the greatest increase. We got like 4% increase in taxable values, and that's because of some uncapping and new development and those types of things that allow the growth in taxable values. But where we will really have a loss, we may have a loss, not as significant, as because of the change in law regarding foreclosures and auctions. Right. And what has to happen with that money. But I do not see on a going forward basis the impact on property taxes that we saw back in the Great Recession. Coincidentally, we lost about 24% of value, and that spread between taxable value and state equalized value is approximately that same amount. So I don't see those losses occurring going forward that we saw in the past.
Yeah,
I'm sorry, let me jump in there for a quick second. This is a great discussion. We could actually have a whole meeting on this, but we got to at some point get back on track and let Keith finish presenting. Thank you.
And I agree, Mr. Chair, but I do think, because Mr. Abbo now has thrown another curve into this future tax revenue, and you know, with the $14 billion of value we can still, but I think, Mr. Chair, this is why we need our fiscal people to be giving a report to the commission. This is our best guess based on these assumptions about where our tax revenues are going, because what Mr. Abbo did not say was that, and I assume from what he said, is that revenues will continue to go down, but just not at the rate of the huge collapse in 2008. I think it's vital that the commission have a better understanding of future tax revenues going forward and all of the things that might affect that.
Commissioner,
Again, this is,
Commissioner,
let me just jump in
do
as chair. Hang on. As chair of this committee, this is a great discussion. We could go on for a long time about this. Maybe we even have the discussion under Ways and Means, but we got to get this presentation done with Plant Moran. And so with that, and I don't want to step on anybody's feet, but I'd like to continue those discussions, but maybe even with Ways and Means, but because our budget year is coming up, but we got to get finish Plant Moran's presentation. Thank you. Keith, please proceed.
Thank you, Mr. Chair. I'm going to pass it off to Nikki to discuss finding number 2.
Thanks, Keith. The next finding is related to certain controls over online banking and the Treasurer's Office. We noted that some employees who are no longer with the Treasurer's Office are still listed on the bank's online system as an inactive or a disabled user, where we would recommend that they be removed from the system altogether if they're no longer working in that office. The Treasurer's Office do have a process to notify the bank of personnel changes, but there is no process in place to verify that those requested changes have been made. It was also identified that certain individuals in the Treasurer's Office have the ability to transfer funds from one bank account to another at the same bank and to open a new bank account, neither function requiring a secondary approval. And so we would recommend that 2 people always be involved in those activities to mitigate any risk of misappropriation of funds. And then also, as a best practice, we recommend that the county implement an online banking policy and review online banking activity logs.
And also, Ms. Cora, we're not going to just gloss over this. We will have another meeting dealing with these issues.
Yes.
Correct?
Yes, we will.
Okay. Thank you. Please proceed.
Mr. Chair,
Yes, Commissioner Dobb.
since we are going to have another meeting going more in depth on these issues, do you want us
Yes.
to hold questions for those meetings?
Well, I appreciate your input too. Thank you. It's a great suggestion.
Okay.
Could I add, though, if there's any questions related to the actual finding itself or the impact that would be tied more to the Plant Moran side, if we could maybe ask those questions today, then concentrate on the corrective action at our next meeting, would that work?
Another good comment. Thank you. Yes.
Okay, then I do have a question, if I'm allowed.
I recognize the voice. Yes, please proceed.
Thank you. This is
But
Commissioner
be
Dobb.
laconic. But be laconic.
So, Nikki, what is the risk to the county by not verifying that terminated employees are removed from the financial institutions, and also that duties are not segregated so that employees can just transfer funds between bank accounts? Like, what's the worst case scenario of something that could happen to the
Right. So worst case scenario, we're not saying that we found any evidence of this, but the risk exists here that someone who is no longer with the Treasurer's Office could still access cash accounts to move or disperse funds. And then with the ability to open a new bank account, the risk could exist that someone could open a new account that others aren't necessarily aware of and transfer money to that account, which they would only have access to.
Okay, so it would open up the possibility of embezzlement much easier?
Yes.
Okay.
Yeah, I think, what we're focused around here, Commissioner Dobb, is really the control itself. So, just like an entity, you want to control who does and who does not have access, who should and should not have access to cash like accounts. So, I think Nikki summarized it very well as, we didn't see anything that came to our attention, but an enhanced control would limit the access to those accounts, which I'm certain are part of your policies and procedures. I mean, that clearly is part of it, to limit access to those who need it, and those who are no longer employed with the county would be deemed most likely not to need access to those accounts.
Okay. All right. Thank you.
Please proceed, Nikki.
I'm going to turn it back to Keith actually to cover the next one.
I meant to say Keith. Go ahead. Please proceed, Keith.
Thanks. Finding number 3 is very closely related to the first finding we discussed related to the misstatements. And this was sort of a cause, and then the results are the uncorrected misstatements. So what we noted going through the audit and digging into some details within particular funds and accounts is that not all of the general ledger activity is being analyzed and monitored on a regular basis. And this is, again, largely due to turnover, people being reassigned, or simply the lack of resources to have individuals monitoring and analyzing all of the general ledger activity on a day-to-day or more frequent basis, and then someone on a less frequent basis to take a more macro view of everything and see that the activity does appear reasonable. So our recommendation, to the extent possible, make sure that there are individuals assigned to monitor and analyze activity on a somewhat regular basis. In the 4th finding, we note instances of non-compliance with laws and regulations. The first instance relates to Michigan's unclaimed property rules, and specifically checks that were not cashed, issued by the county but not cashed by the individuals, primarily related to road construction performance bonds and agency liabilities. So after a certain period of time in which those checks are not checks are not cashed, that's required to be reported to the state on an annual basis and potentially escheated to them as well. The remainder of the finding relates to non-compliance with the Budget Act. We noted instances in which actual expenditures exceeded the amounts approved in the budget. And on a budgetary basis, the county is permitted to use all of its fund balance and current year resources, but cannot budget to be in a deficit or actually end the year in a deficit. But we did note a couple instances of each in which the budget called for more spending than was available, and a couple funds in which the actual fund balance was negative at the end of the year. And then last, we noted that there was no budget approved for the building authority. Then finding number 5 relates to the capital asset issues that we talked about along with finding number 1 as well. But to build a little bit off of Mr. Dubé's comments, this finding has changed in nature over the last couple of years. I would be comfortable saying that there have been improvements made in the way in which capital assets are reported. And while there were still some issues related to the typical transactions, a large part of this finding also relates to the complexities of the Criminal Justice Center project. So we suspect those have been ironed out by now and won't recur going forward. With that, I'll let Nikki talk about the last few financial statement findings.
Thanks, Keith. The next finding, finding 6, is related to the voids process in the treasurer's office. So during our testing, we identified that there's no formal process outlining the procedures for approving voided transactions. And so there's no audit trail to support voids that happen at the counter. And to that end, no control in place that prevents a cashier from voiding a transaction with no approval. And so our recommendation here would be that a process be implemented to ensure that these voided transactions are properly approved and documented. The
Mr.
next,
Chair, this is Commissioner Dobb.
Yeah.
I have a question.
Sure.
Go ahead.
Thank you. So Nikki, this is just kind of the same question I just asked on the last issue. So what is the risk or the impact to the county by not having the controls over voided transactions? What's the worst thing that could happen?
Yep. So the risk here is similar to the previous one, where without that control in place, there's nothing that nothing to support that voided transactions are valid transactions, and again could lead to a misappropriation of funds.
Okay, so what's an example of something that could happen at the treasurer's office?
So the risk here,
like,
okay, so worst case scenario again, and we again, we found no evidence of this because there was no audit trail to test, but the risk does exist. A person could come in to pay a bill with cash, that transaction is voided in the system, and the cash is pocketed.
Okay. Okay, thank you.
Yep. Moving on to the next finding. It relates to the process for reconciling cash. So the county has a two-step process in place where the treasurer's office does the first part of the reconciliation, starting with the bank balance and reconciling to their system. And M&B is responsible for the second part of the reconciliation to agree to the general ledger. And we noted during testing that for numerous months, these reconciliations weren't completed or reviewed timely, and that certain reconciling items couldn't originally be supported at the time of testing. And our recommendation would be that a reconciliation process involving both offices be developed to ensure that bank reconciliations are prepared timely and that all reconciling items are identified and supported monthly. And the last financial statement finding, number 8, is related to the processes and controls surrounding inmate property cash accounts. And so there were 3 main items identified as part of our testing. The first being that a reconciliation between the jail management system, which includes the detail by inmate, and the inmate property cash account is not done during the year. And so our recommendation is that this reconciliation be performed monthly to ensure proper balances are maintained in that jail management system. And then based on our review of the outstanding checks associated with this account, they go back about 15 years and cumulatively have been increasing every year. And we recommend that the county review these outstanding checks to ensure the listings are accurate and that old checks be issued to the state. The last item we found is that approximately 60 individuals at the 3 jail sites have access to blank checks, which is more than what might be deemed necessary for operations, and that a significant number of individuals have the ability to sign checks cut out of that inmate property account. Our recommendation is that blank checks be stored and signers limited to necessary personnel only. And so that concludes the financial statement findings. I'll turn it over to Amanda and Shawana to cover the single audit results.
Thanks, Nikki. So before I have Shawana go through the single audit findings, what I wanted to do is take an opportunity to highlight a few of the federal award items to give perspective about kind of the context of the audit that we performed. So in the fiscal 19 audit, the county expended about $52 million of federal awards in comparison to about $57 million in 2018. And that resulted in us testing 5 major programs. And those major programs included WIC, CDBG, Home, the Health Center Cluster, as well as child support enforcement. And that testing resulted us testing about 33.8 million of the expenditures, or about 65% of the total federal awards that were expended during the year. And certainly we have criteria that we need to follow, a certain set of rules that are prescribed that tell us which programs we need to test as major, and we do that every year. This year, I'm happy to report that we rendered unmodified opinions on all 5 major programs that we audited. And if you recall from prior year, we would have audited 8 major programs, but we actually had 3 opinion modifications and question costs that were reported. This year, we have no opinion modifications, and we also have no question costs that we need to report. So I wanted to make sure that we took an opportunity to highlight that. We did have 3 findings this year that Shawana will go through momentarily. 2 of the 3 findings are repeat findings, so we actually only have 1 new finding this year. And if you recall, in 2018, there would have been 10 findings related to the federal awards, which there's only 3 this year, just to give perspective. Commissioner Basham, I don't know if you were about to say something?
No.
Okay, perfect. So Shawana, can you walk us through the 3 single audit findings, please?
Sure. So starting with finding number 9, that one was related to the CDBG program. And this one was a material weakness and material non-compliance with laws and regulations. So that is kind of the most severe level of finding that you can have on a program. This one was related to program income. So federal awarding agencies require recipients of program income, and program income would be any monies earned in connection with the program that federal awards are expended on. So the federal awarding agencies require that when program income is received, that program income is recorded, and that if it's retained, it's used for eligible purposes. As Amanda mentioned, this is one of our repeat findings, but the county has had an improvement in its process in this area. It is now tracking the receipts of program income appropriately, whereas last year's comment would have been that it was not being tracked. Just the finding this year now relates to, while that program income is being tracked, it's not being recorded in the CFA, in the general ledger. And so that lack of reporting in the CFA or the schedule of expenditures of federal awards, which is our financial report for the single audit, has resulted in approximately $400,000 of program income not showing on the CFA. So an understatement of the CFA by approximately $400,000. So some process improvement, as I mentioned there, but still a repeat finding, just a little bit of a change in the nature of that finding from last year. Moving on to finding number 10. This one also relates to CDBG, but also relates to the home program as well. This one is also a material weakness and a material non-compliance with laws and regulations, and is a repeat finding from the prior year. The federal awarding agency that awards these two grants, CDBG and Home, requires the submission of an annual summary report called a Section 3 summary report. And consistent with last year, that report was not filed this year, so it's just a missing report that the terms of the grant agreement would require for both CDBG and for Home. And the last one is finding number 11. This one is a significant deficiency, and it's related to the WIC program, and this is the one new finding that was this year, so not a repeat from the previous year. So the county subrecipient agreements, so these are agreements with other entities that they pass federal funding through to, that stipulates that those subrecipients, when they request reimbursement from grant funding, that they provide supporting documentation along with their reimbursement requests. But what we found in our testing is that agreement, or that stipulation within the agreement, was not being enforced. We did not identify any questioned costs or any costs that we thought were inappropriate as a result of our testing, although the support was not attached. But the county's agreements do say that support should be attached, and we were finding that it was not attached in all cases, and providing that support was not being enforced. The risk there being that if subrecipients are not being required to kind of follow the terms of the agreement and provide that support, that there could be questioned costs in the future that aren't detected, or costs that are non-compliant with the terms of the grant agreement. And that summarizes our 3 findings related to the federal awards audit. Were there any questions on those?
Actually, we've got a lot of questions, but we got another meeting in about 10 minutes, so I'm trying to get the presentations done, and then our next meeting, we're going to dig down into all these questions that's basically been raised by our external and internal auditors. Thank you. Please proceed.
So, Commissioner Bashan, I was controlling the single audit report there, or someone that gave me control.
Yes.
So I think we're back to the graph package. So I'm not sure where that is in this document, because this isn't mine. But maybe we can just walk through quickly.
Sure.
There's only 3 more slides, and really the last 3 slides are really focused on the consideration of fraud in the financial statement audit. As I mentioned earlier, really the purpose of our audit is to provide an opinion based on the processes and procedures we performed related to the audit, and how that information was presented within the financial statement. What's also required under the auditing standards is for us to consider fraud in a financial statement audit. So we need to determine what conditions might be present to allow fraud to occur, how management could perpetrate and conceal a fraud, and finally, how assets could be misappropriated by management or employees. So while we don't necessarily test to that, we have to have an understanding of the environment and how that could allow those weaknesses in the system and any of those three items I just mentioned to occur. So part of that standard requires us to inquire of management. So we've talked with some of you about this prior to the audit starting, as to your understanding or awareness of how fraud might occur, what risks there might be out there, and maybe perhaps what steps management has already undertaken to help mitigate these fraud risks. We also are talking with folks who might not necessarily be directly involved with those type of procedures. So with that, we've had discussions with 4 elected officials, 3 financial executives, and then finally another individual throughout the county. So what we're trying to do is get outside those who are really responsible for reporting and recording the information or have custody of the assets, and just asking and inquiring, are there any additional concerns out there related to those matters are discussed? If something is brought to our attention, we would tailor our audit programs appropriately to try to address those items and lower our risk or lower the overall risk so that we can issue either one, continue to issue an unmodified opinion, or present a finding to present to the audit committee at this time. So that is our presentation as it related to the PowerPoint. We would be happy, I guess I'll defer to the audit committee chair as to what you would like our role to be going forward, or if there's any questions that we haven't asked yet or haven't been asked yet.
Well, I think there's a million questions out there, and I think overall, from a macro point of view, I think it's being pointed out that we have made improvements from last year, but we still got a lot of work to do with the help of the auditors, also the administration, and the commission itself. So basically, I'm trying to keep the questions, and there's a million out there. I don't want any church mice or anything, but I'm trying to, I think you did a great presentation. I think Matthew did a great comments that we could have had major discussion on for a long period of time. But again, there's so much in this, it's hard we can't resolve it in just this one meeting. So, it was presented well, and I look forward to working with the Auditor General, her staff, and her guest at our next meeting.
Mr. Chair, I'd like to make a motion.
Could I just add one thing, Commissioner Kleen, real quick, if you don't mind?
I haven't made the motion yet.
So we spent a lot of time in the presentation focusing on on the findings, which we need to make sure we're presenting to the audit committee. What I think we cannot lose sight of is there was an unmodified audit opinion, highest level of assurance, and really the tremendous effort that's put forth by M&B, the Auditor General's office, and the Treasurer's office, among others, to be able to provide us the information so that we can complete the audit on a timely basis. This is in addition to all of their other responsibilities during this time frame, and there's tens of thousands of entries, and to get to that point where we've got an unmodified opinion, just a sense of gratitude for M&B and the Auditor General's office for another great year of working together at on the county audit. Thank you.
Thank you. Commissioner Kleen.
Mr. Chair, I think the appropriate motion, so that we can just pick up at the next meeting where we're leaving off here, is to pass items 1 and 2 for the day. That would be my motion.
Accept the motion. Is there a second?
Second.
Okay, it's been moved and seconded. All those in favor, or any discussion?
Who moved and supported it? I'm sorry, I didn't get that.
Commissioner Clark Coleman.
I support.
And then, is there any further discussion? All those in favor?
Aye.
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 All those opposed? Ayes have it. Next item, Madam Clerk.
I'm sorry, I didn't get who moved the item. I got Clark Coleman.
Colleen.
Commissioner Colleen,
Wait, okay,
the Irishman,
okay, I got it.
supported. Okay. It's been moved, supported, and voted on. Next item, Madam Clerk.
E, such other matters as may be properly submitted before the committee.
There are none.
Public comments.
Is there anybody from the public who would like to comment? Anybody from the public that would like to comment? Last time, anybody from the public like to comment? Next item, Madam Clerk.
Adjournment.